Strategists are forecasting a bumpy ride for at least the first half. Do you agree?
Yeah, I would say uncertainty, macroeconomic uncertainty, as well as the reaction function of central banks, global central banks. I think that uncertainty remains with us through the course of next year. I do think some of the growth uncertainty increases because the economy is robust right now. I think there was a lot of pessimism around recession risks over the last month. That can fade, but as the cumulative impact of the global tightening in financial conditions starts to feed through to the consumer, as that accumulated savings buffer starts to run out, we actually think that the economy will, the U.S. economy will head into a recession in the third quarter. So I think the uncertainty around how strong is the consumer, how strong is the economy, I think that'll just build through the year. And the other big uncertainty that we've all struggled with this year around inflation, I think that also stays with us. Some of the low-hanging fruit around inflation, I think that's come off. But does the consumer start to slow down in terms of service demand? Does the wage picture start to slow down? How sticky is that inflation going to be? So I think we'll be struggling with a lot of the same issues. How sticky is inflation going to be on the way down? How strong is the consumer? And then how does the Fed navigate what we think is going to be dueling, conflicting mandates? I think that's going to be with us all through next year.
What do you make of the rates picture today and the volatility we've seen coming into the end of the year? I mean, a month and a half ago, we were at 4.25, and a couple of weeks ago, we were at 340, and today we're jumping back up to 381, 382.
So I think it's important to know that the fixed income market is not the most liquid, and particularly this time of the year, I think flows, get exaggerated in terms of price action. So I think it's important to keep that at the back of our mind. But I do think there's been a subtle shift in the market that was obsessed with inflation through most of this year, as central banks were. And then in the last month, I think recession fears really came up. And the way I would point to this is it was a real rate-driven decline in rates. The number of cuts, Gershon brought this up, the number of cuts being priced in from the middle of next year all the way out to 25, that increased a lot. We had 200 basis points of cuts, Fed cuts being priced from the middle of 23 to 25. So I think the market began to price in recession. We've had some data in the last, I would say in the last month, that is conflicting with this idea that the recession is right upon us. Now, we are looking for a recession at TD, but we're looking for that at the end of 23 rather than at the start. So I think in the near term, we're actually looking for higher rates, but I'm going to use that as an opportunity to start to layer in duration risk. I get concerned about credit risk at some point. As if the economy heads into a recession, you want to be in longer duration treasuries. You want to be in the safest assets. So I'm looking for rates to slightly head higher in the near term and then use that as an opportunity to position for a decline in rates. It's going to be volatile, not an easy ride, but I think rates are going to decline through the course of next year, just not going to be in a straight line, because the economy is still very strong.